Unlock the secrets to successful investing with Warren Buffett's 6 time-tested rules that have made him one of the world's most successful investors. Hello, and welcome to this video about Warren Buffett's 6 rules for investing. Warren Buffett is widely regarded as one of the greatest investors of all time, and his approach to investing has been studied and emulated by many successful investors. In this video, we'll be discussing Buffett's 6 rules for investing and how you can apply them to your own investment strategy. Number 1. Invest in what you understand. The first rule of Warren Buffett's investing philosophy is to invest in what you understand. This principle emphasizes the importance of investing in companies that you have a good understanding of and avoiding those that you don't. Buffett is known for investing in companies that he knows well and can easily explain to others. This means that he avoids investing in complex financial instruments or industries that he doesn't understand. This rule is important because it helps investors avoid making decisions based on speculation or hype. When investors understand the company they're investing in, they can make informed decisions about its potential risks and rewards. They can also better evaluate the company's management team, financial statements, and competitive landscape. Investing in what you understand can also help you avoid emotional investing. When investors don't understand a particular investment, they may be more likely to make impulsive decisions based on short-term market movements. By investing in what you understand, you can maintain a long-term investment strategy and avoid making costly mistakes. Number 2. Value investing. Warren Buffett's second rule of investing is to practice value investing. Value investing involves looking for companies that are undervalued by the market and have a strong intrinsic value. This approach contrasts with growth investing, which focuses on buying stocks that are expected to grow rapidly in the future, regardless of their current valuation. Buffett famously looks for companies with a moat, which is a competitive advantage that helps the company maintain its market position and profitability over time. By investing in undervalued companies with a strong moat, investors can potentially achieve high returns over the long term. This approach requires patience and discipline, as it may take time for the market to recognize the true value of the company. However, by investing in undervalued companies with a strong moat, investors can potentially benefit from the power of compounding and achieve higher returns over time. Number 3. Buy and hold. The third rule of Warren Buffett's investing philosophy is to buy and hold. Buffett believes in investing for the long term, and he's famously held some of his investments for decades. This strategy involves investing in high-quality companies with a long-term outlook and holding on to those investments for an extended period of time. Rather than trying to time the market or make frequent trades, buy and hold investors focus on the long-term potential of their investments. Buffett's approach to buy and hold investing is based on the idea that high-quality companies with a strong moat will continue to generate profits and grow over time. By holding on to those investments for a long period of time, investors can benefit from the power of compounding and potentially achieve high returns over the long term. By focusing on the long-term potential of their investments, investors can avoid the temptation to make impulsive decisions based on short-term market movements. This can help investors avoid costly mistakes and achieve higher returns over the long term. Number 4. Margin of safety. The fourth rule of Warren Buffett's investing philosophy is to always invest with a margin of safety. This means that investors should only invest in companies that are trading at a significant discount to their intrinsic value in order to protect against potential losses. The margin of safety concept is based on the idea that the future is uncertain and that unforeseen events can impact the value of an investment. By buying stocks at a price below their intrinsic value, investors can protect against potential losses and potentially achieve higher returns over the long term. To determine the margin of safety, investors need to have a good understanding of the intrinsic value of the company they're investing in. This involves analyzing the company's financial statements, competitive landscape, and other factors that can impact its future profitability. By maintaining a margin of safety, investors can also protect against emotional investing. When investors buy stocks at prices above their intrinsic value, they may be more likely to make impulsive decisions based on short-term market movements. By buying stocks at prices below their intrinsic value, investors can maintain a long-term investment strategy and avoid making costly mistakes. Number 5. Focus on the long term. The fifth rule of Warren Buffett's investing philosophy is to focus on the long term. Buffett's known for ignoring short-term market fluctuations and focusing on the long-term potential of his investments. Buffett believes that focusing on the long term can help investors avoid short-term market fluctuations and make more informed decisions about their investments. By focusing on the long term, investors can look beyond short-term trends and focus on the underlying fundamentals of the companies they're investing in. One of the key benefits of a long-term focus is the power of compounding. By reinvesting the dividends and capital gains from their investments, investors can potentially achieve higher returns over the long term. This approach requires patience and discipline, as it may take time for the compounding effect to take hold. By focusing on the long-term potential of their investments, investors can avoid making impulsive decisions based on short-term market movements. This can help investors avoid costly mistakes and achieve higher returns over the long term. Number 6. Keep it simple. The sixth and final rule of Warren Buffett's investing philosophy is to keep it simple. Buffett believes in investing in simple, easy-to-understand companies that have a clear competitive advantage and a strong track record of profitability. Buffett believes that investing in complex industries or companies with convoluted financial statements can increase the risk of making poor investment decisions. By investing in companies with simple business models and easy-to-understand financial statements, investors can make more informed decisions about their investments. This approach allows investors to avoid the temptation to chase fads or make speculative investments. By focusing on companies with simple business models and a proven track record, investors can avoid the risks associated with speculative investments. Keeping it simple also helps investors avoid information overload. In today's fast-paced digital world, investors have access to an overwhelming amount of information. By focusing on a few key metrics and companies, investors can filter out the noise and make more informed decisions. That's it for today's video on Warren Buffett's 6 rules for investing. Remember, Warren Buffett's 6 rules for investing can provide valuable guidance for investors looking to achieve long-term success in the stock market. So, try implementing these rules today and see the positive impact they can have on your investment portfolio. Don't forget to like and subscribe to our channel for more amazing content. Thanks for watching, and we'll see you in the next video.